So first of all, thank you, Dale. Thank you, Mark. Thank you, George, and thank you, United Potato Growers, for inviting us back again this year. A lot to talk about this year, and I think that's the thing I want to start off right off the top is there's so much to talk about, and I think about the last several years. We seem like we've talked about a lot of the same things, and we will talk about some of the same things, but there's some things we need to talk about and think about this year that maybe we haven't thought about in the past years. So we're going to jump right in here this morning because the time goes fast. This came in on Millennium Baking News just last week, and you might see the quote if you can't read it is this finally going to end? And he's talking about the China trade. But I think this is a good question for a lot of things. So is the weather ever going to end and be nice? Is the trade war ever going to end? Are prices ever going to end and get better? And you just get the list. And that I thought that really captured a lot of things in a very quick hit. So let's talk, and we're going to spend a lot of time mostly on the macro view this morning, and we'll talk a little bit about the commodities as we go forward. But I kind of want to set the stage for you all and have you think about some things this year. You know, the trade war tomorrow, the Chinese are in Washington and it's supposed to be signed tomorrow. A couple of things I want to say about it, and I'm not going to read all this to you, but I think the thing we have to think about is that if we think about all the announcements about $40 billion or $50 billion the Chinese are going to buy, they're going to buy corn, soybeans, wheat, ethanol, all that. Most of that's come from our side of the table. It hasn't come from the Chinese side, and the Chinese haven't made many promises. And for those of you who followed China for many years, the Chinese do make promises, but they don't usually keep them. And so I think we have to, let's put this in context and keep it in perspective. The other issue is that through all this phase one, no one said the tariffs are going away. And so the tariffs are still going to be in place. Now the Chinese have made some changes in the paperwork and the waiver process, but the fact is this is not done yet, and there's a lot more yet to come. So we'll see what tomorrow brings. As an economist or an analyst in this, I'm hoping for more detail than what we have so far. You can see some of the other trade agreements in the works down there, but I do want to say, and I think I've mentioned this before, but I also want to make sure that we understand we are going from this multilateral trade agreements like NAFTA, like TPP, GATT, that whole Uruguay round, for those of you who are older, remember all that, to this bilateral. And this makes it a little more challenging environment because you and I might have a trade agreement and you and your neighbor might have a trade agreement, but they might be different rules. They're going to be more expensive that way because you have all these rules to figure out. Everyone's going to be different. And so I think that is an environment we're going into now that's going to be more difficult for those of us, particularly in agriculture, those of us who trade, to figure out, okay, I'm trading with them. These are the rules I have to follow, but maybe my neighbor has an advantage that I don't have. And so I think that's something we have to think about. The playing field is not as level as it was. I am skeptical about the $40–50 billion. And I'm going to point, the green bar is the value that we've given, that we have sent to Chinese of ag and related products over basically the last 20 years. The top number was 28 billion, so we've got to make up $12 billion someplace, and prices are even lower today than they were back when that was made. So how do we get to that point? Makes me a little skeptical that we're going to get there in 20. I mean, the talk is, well, it'll happen this year and next year. I think that's going to be a challenge going forward. Let's talk a little bit about grain trade and a little bit about global trade. And I circled that bar, and I'm not going to talk a lot about the bars as far as the share, but I want to talk about that line. If you look at the last 4 years, think about what's happened to global trade. It's kind of flattened out. And this is corn, wheat, and soybeans, but generally if you look at global trade numbers across, we've seen a flattening out of the global trade. And if that's the case, that means that just because we might see more trade, we're just reshuffling the deck chairs. We might get it next year, Brazil gets it next year, Mexico gets it this year, we lose it this year. And so it just makes a much more competitive environment, and it all comes down to price. And I should mention, keep in mind the Chinese, they're price buyers. And so despite what the agreement might come up, the fact is they're going to buy, and that's what's happening in global trade. It's all about price. I do want to mention a couple things. I'm going to go through these two slides really well. This is global grain supply, corn, wheat, and soybeans. We've had a lot of questions about, well, the stocks are contracting and we should get better prices because the stocks go down, prices go up, and generally I would agree with that. But the fact is, we're still producing tremendous amounts of grain and oil seeds in the world, and even though stocks are coming down, which you see here, they're still at very, very high levels. And that's the question we get is, well, doggone, they're contracting, or we have a bad year, and why aren't we getting higher prices? And it's because we're still producing a lot in the world, and we still have large stocks. And I'll show you the U.S. numbers are very, very similar to the global numbers. When we look at global growth, and that's the other thing, it kind of goes with the global grain trade flattening out, is that we see GDP around the world sort of flattening out. China's going down. It's a large country. They're not growing as much as they were before. India is growing. That's a good market. Southeast Asia is growing. And those are two markets where the opportunities are. And we've talked about that before, but I want to reemphasize that. And I think when we talk to our friends in the trade associations and talk about with traders, those are parts of the world they're looking at for opportunities. Not that they're shunning China, but they're realizing that China is not the only game in town. We talked about the dollar index. It's come down, and that's important. And that's important to agriculture, important to agriculture. But I want to make sure that we understand that it's our trading competitors in the world we have to follow. You can see it in all cases, other than maybe the ruble. The ruble's been pretty flat, and that's where we compete from a wheat perspective. But look what the real and the peso have done. They continue to depreciate against the dollar. And so the up line means it's depreciating against the dollar. That continues to be the case going forward. That the dollar is not competitive in the world, and the currency has a huge impact on how our commodities are perceived in the world by buyers. And as long as that happens, it's going to be a very tough road for us. You can see the Chinese, there's been a lot of fluctuations in the RMB, and there's been a lot of talk. The Treasury, I believe it was yesterday or is going to announce today that they're not going to label China a manipulator of currency anymore. You can see that the ruble or the RMB has come down against the dollar, has depreciated against the dollar a little bit. So that makes them more competitive in the world, but it then makes it harder for them to buy from us because they don't have it makes it easier for them to buy from us, but it makes their exports a little more expensive in the world. So we have to watch the RMB because that has a big impact on how trade moves forward. We always get the question about interest rates. So that bottom line you see there on your far left, that's where we are today, 1.5, 1.7 on the open market. And you can see over the next, and this is 4-year numbers, and those are really small. This is coming out of the FMOC. You can see that we've got about a 75 to 100 point increase when we get out to 2022, and even look longer term, it stays about there as well. We think, and I will tell you, when we look at our numbers, we've kind of thought about a year ago when we talked, we had a lot about concern about recession. We think those numbers we think that probably has leveled off. We're not going to see the growth in GDP, and I'll show you that in a minute, but the fact that interest rates have been relatively flat and have come down a little bit probably does not bode well for a recession coming this year. And there's the US GDP. You can see it has slowed, and it has gotten a lot less volatile in the last several years, and we think that the Fed spends a lot of time. I also think that with the competition around the world, but whether it's in labor, whether it's in commodities, whatever number you want to talk about, our GDP rates are going to be very slow rate going up. I think the other thing you have to think about is when you look at this from the Great Recession of 2007-8 to today, it's been one of the slowest recoveries in history. And that's what's really remarkable about this. And I will tell you, there's a lot of economists, me included, scratching our heads as to why is the economy growing so slow? Why are wages growing so slow? We have a continued, and I don't want to get too political, but we talk about income equality, and you think about people who have college educations and getting more of that income stream versus those who don't. So it's really been a puzzling time for economists to figure out why it's happening what we're having. Even though the economy is good, people have jobs, people can get jobs, it's still been very slow growth. And we think that will probably continue. Talk a little bit about what's going on the farm. And I'm going to talk a little bit this. When we look at crop budgets for over the last 8 years, they've been, and we don't see this changing anytime soon, we continue to see negative margins going forward. And that's pretty much across the board. And I'm going to talk a little bit more about what's happening in the country. But at the same time, we're not in a farm crisis. When we look at, for those of you, I can see lots of gray hairs, remember the 1980s, we're not in a 1980s farm crisis. And I'm going to come back to that a little bit here in just a second. But I think we're looking more like the 1990s. And I'm going to credit Jason Henderson at Purdue University talking about this, and you might look up some of the stuff he's talked about. But think about what happened in the 1990s. Land values continued to increase slowly. We saw basically level commodity prices, very small margins. We did see more government help or saw more government intervention in agriculture, whether it was policy or whether it was money. And so we're in a situation now where we're probably going to be here for the next, probably for a while. And I think that's something we have to think about and plan accordingly. But having said that, we have to think about, we all have neighbors who are in a farm crisis, who are struggling and are probably, unfortunately, may not make it or be able to farm next year or the year after. And I think we have to be conscious of that and sensitive to that going forward. But we do see agriculture continuing to consolidate, whether it's at the production agriculture level, whether it's at the inputs, or whether it's at processors. We continue to see that consolidation in this period of high volume, high stocks, and low prices, or relatively low prices. And I showed this this is corn, farm gate corn prices back to 1900. And you can see exactly where we are, where we're here, where prices have gone up, the demand curve has moved up and to the right, and now you see prices slowly deflate over that time period. And so prices, commodity prices, and the price of production could basically kind of come together at the end of that period. And these periods tend to be kind of 25 to 35 years. And so we're probably 10 years into this, and so you can see the 1990s pattern fits very well where we are today. And you can see that that line here right now is probably going to flatten out as we go forward because we're going to see prices kind of continue to stay fairly level where they are today. I bring up government assistance, and I know this is a touchy subject, but I do want to bring it up because you can see right now agriculture in the last 2 years, because of MFP and primarily, has gotten about $28 billion in assistance from the government, all due to trade, and so we'll acknowledge that up front. But you can see we're starting to rival the assistance that agriculture got in the 1990s and even the 1980s. And one of the things we're hearing both out of the country and also from other people in the industry are saying, well, my business was affected by the trade, why am I not getting any assistance? And I want to emphasize that because agriculture is a special place and we all love agriculture, but we have to be sensitive that other people have been hurt by this trade war as well. And so I think you have to be conscious of what's happening outside of our sector, because we all get into our sector and kind of think about it and forget about everything else. But there are people now looking at agricultural payments or agricultural assistance from the federal government thinking, we need to think differently about this than we're thinking about right now. So I just kind of want to bring that up. But when we look at some of the conventional measures, yes, we are starting to see a little stress, but it's not outrageous. This is the debt to asset ratio is now about 14%. Come up from a low of 11%, but it's nothing like it was back in the 1980s where we were way above 20%. Now these are national aggregate numbers, so this may vary widely by region, but it's at least a perspective to think about. The biggest issue in agriculture right now when we look at production agriculture is the fact of working capital. We've seen a tremendous decrease in working capital, and I'll say one thing as bankers, that's something we've been working with all of our borrowers is to try to get that working capital back up, and so we would encourage that. But you can see the tremendous decrease in working capital at the farm level just in the last 3 or 4 years. So now let's talk about planted acres a little bit. And this is probably going to be a battleground, and there's going to be a lot of arguments between now and March 31. And I'll tell you the numbers where we are, and this comes out of our 10-year baseline model. So we're looking at about 90 million acres on corn. We're looking for about 79 to 80 million acres of beans. This is what's coming out of the model. Cotton right now, we're looking at a little under 13 million acres for those of you who have any cotton interest. And we're looking for about a million acre increase in wheat. We may have to revisit that after seeing winter wheat acres last week being basically down again, which is a little surprising. But I will say, I think the corn number probably is 90 to 92 million acres. Look at beans as where the battleground is going to be. What is that bean number going to be? And we are having, as I call, a spirited discussion internally, and we've got about 10 million acres. We've got to figure out where it's going to go. I think when we look at the economics of beans, it doesn't make sense in some ways to plant beans, but you need it for rotation and stuff like that. That number may actually end up closer to 83 to 84 million acres before it's all said and done, because it looks very similar where prices are today, looking at them a year ago. and you look at planting intentions a year ago, that's about where they were. So we'll see what happens. It's really going to be interesting going forward on that. Here's the two charts I just talked about with the world. Look at U.S. We're still producing a lot of stuff. This is corn, wheat, and soybeans. We still have a lot of that. You look at stocks, yes, they are down, but they're still at the upper end of that range going forward. So that's the problem is, and I know from potato people, I know from sugar beet people who might be in the room, you look at what happened in the northern plains, you look across the Corn Belt in the spring, and everyone was thinking, well, how could we produce a crop? Why aren't prices responding? And this is one of the reasons, because we have plenty of stocks in-house. If corn, just to give you an example, if corn ending stocks was 1 billion bushels or 1.2 billion, we'd have a whole nother discussion today than what we're having right now. Prices would be in a much different spot, and the market would be a lot more jittery than it is going forward. So I've got a little bit, about 10 minutes left, 10 to 15 minutes left, and so I'm going to talk about, let's talk about wheat, and I'm going to talk about what our baseline is showing. So here's kind of the bearish things in wheat, or kind of the bulls and bears of wheat that I always talk about. You know, I think wheat's going to be really interesting here. U.S. exports of wheat should pick up over the next several months. The Black Sea's pretty well run out. We also see Argentina has a lot of political issues and economic issues to deal with that they've got to figure out. Where are they going to export? And they're probably going to raise export taxes, which should be good for us. And our friends in Australia obviously they're in their third year of drought, and we all know about the fires there. I will tell you, in talking to our colleagues in Australia, it hasn't hurt the agricultural lands yet, which is sort of the good news. The bad news, it hasn't, because of the drought, they have nothing there to burn, to be honest. And so there is opportunities in wheat, I think, going forward, and we'll talk about that a little bit as we go forward here. You can see the all wheat balance sheet still looks pretty good in that number, and I'm not going to, for those of you who love numbers, you'll love these tables. I have people in the bank who said, why do you show all those numbers? No one likes those. And I've had several people come up to me during presentations and said, I love the numbers, just showing the numbers, I'm happy. But you can see that we do have plenty of ending stocks on wheat. HRW is also we're still about 500, almost 500 million bushels, so there's plenty, and that's in the lower left-hand corner there. So HRW is not the problem. SRW is where the issue. It's 106 million bushel carryover. So we're talking about the eastern Corn Belt, and that's where we saw the increase in winter wheat acres, and we saw a decrease in winter wheat acres basically west of the Mississippi River, all the way to the Pacific Northwest and all the way to Texas. And so that's where probably the opportunity is going to be in those markets, and I'll come back to that in just a second. So here's where we look on wheat acres. This is from our baseline. 75% probably wheat acres over the next 10 years are going to kind of stay about 49 million bushels or less. So keep that in mind. We just don't see the increase in acres. We see a little increase from where they are now, but the fact is we continue to see increases in yield, so we continue to produce enough wheat to keep the United States full, and then we have to find a home for it overseas where there's lots of competition. You continue to see that, and I talked a little bit about this, but this is, you can see the winter wheat acres declined again this year about 1 million acres. And we have not seen the spring wheat acres numbers or durum wheat acres, but you can see those winter acres continue to decrease, which is interesting in the standpoint of we continue to produce enough, but it also provides opportunities, and that's what we'll talk about going forward here. When we look at wheat prices, the unfortunate thing is that we see when we look at farm gate prices, 75% probably they're going to be under $6 over the 10-year baseline. But that's a cash price, but I think we have to think about where the opportunities is in the basis side. Now this is Portland, this is HRW, and you can see it's running about where it typically does, and that the circle is where we are today. But look what's happening when we look at HRS, hard red spring. Demand for protein, and that's always one of my mantras is we look at market is looking for protein, and look at where HRS Portland basis levels is very, very high. It's mirroring really almost the high levels we've seen over the last 3 or 4 years. So one of the things, and we see this across all the markets, is futures may not be your opportunity, and as we look at the 90s and look at what's happening today, futures are probably locked in a fairly narrow range. Doesn't mean we're not going to see supply shocks because of other issues, whether it's drought, whether it's floods, But the fact is your opportunities from a marketing perspective are going to be in basis. And so we want to make sure that you focus on that. And one of the things I just kind of one little thing to talk about is that I know it's a good year for potatoes, and I know there's some people who don't have a good year in potatoes, but I want to also kind of leave with you and deposit with you that don't forget those other crops that you're producing. And I understand potatoes is the meat and potatoes of your business, but don't forget about those rotational crops, because there are opportunities there that someone may be taking advantage of you because they can buy a cheap wheat, or they can buy whatever the case might be, cheap barley. But think about those opportunities and make sure you spend as much time marketing those crops as you do worrying about that potato crop. And you can see, here's an example right here. Here's the other. This is soft red winter wheat at the Gulf at the Gulf of New Orleans and Gulf of Mexico, and you can see they're at record levels right now. So again, there's the opportunities, and those, while those are export markets, those bases will back up. Those will back up into the country. I'm going to focus on the Idaho and Utah people for a moment. These are cash basis. Excuse me, I'm mixing up. These are basis levels, values for Idaho and Utah for number one HRW. So you can look at sort of some seasonality, and you can see that that basis level continues to climb, and it does seem to have a height in that fourth quarter of the year. So I want you to think about that from a marketing perspective, and think about this may be a good time to start looking at and thinking about marketing that wheat, this year's wheat now, because you have fairly high basis levels and buyers are trying to get their book established or starting to put a book together. If you wait too long in that volume, they get some volume in, they're going to back away and think, well, I don't have to worry because that volume is going to come to me. But I want you to think about that's where the opportunity is in the basis market going forward. And in these, as you can see, these are basically eastern Idaho and northern Utah numbers. So something to think about, and something that would be worth talking about with your marketer, and also with maybe your merchandiser or who your buyer is. You can see this year, this is protein percentages for the 5 classes of wheat. Everybody went down but white wheat, and that's again the other opportunity. And I think I have this slide in here. Yeah, the circle is Kansas City 12 is the basis for Kansas City 12% protein. And that's again where the opportunity is. If you're producing high protein wheat and you can do it on a consistent basis, there are buyers for that, because there's a lot of dislocation of protein around the country. Think about what happened in the northern plains this year. You know, wheat is not going to be in the places it needs to be. It's the same thing with corn. It's also the same with soybeans. And so basis levels are going to be all over the place, but you may be in a spot where they need a product, and so your basis will reflect that. But we're starting to see those basis levels around the country start to pick up, because all that cheap high protein wheat is gone, and now the buyers are going to have to bid for it to get it up, to get it to there. And this is primary bakers or flour millers. When you look at wheat stocks, yes, they are contracting, but it's really only durum and soft red winter wheat that are really tight. We have plenty of HRW, we have plenty of HRS, and that's reflected in the acreage numbers going forward. But you can still see we're still at very high levels for U.S. stocks here going forward. So I'm down to about 5 minutes, and so I want to be respectful of your time and respectful of the other speakers' time. So I'm going to just go quickly and talk about corn and a couple of things going on with corn and soybeans. Let me back up one thing about wheat I want to talk about real quickly. When we did our 10-year baseline, the other opportunity in wheat, when we looked at the demand components, and this is reminding on corn, when we looked at the demand components, the flour milling continues to increase. And we see a compounded annual growth of flour or food use of wheat just under 2% per year, where exports are flat, and of course, you know, feed and seed are basically flat as well. So if you're closer to a flour miller, build that relationship, because that's where the opportunity is. What reminded me of that on the corn side is the same thing. When we look at corn demand going forward, it's basically flat. The only category that is good in the corn side is the feed side. And we continue to see compound annual growth in the feed side on corn a little under 2% as well. And so we kind of see, for those of you who are old like I am, you know, we remember we all used to have livestock on the farm, and we raised crops, and we probably even had some chickens, and heaven knows what else we had. But we fed that crop that we produced to our animals, and we walked that grain off the farm. The last 10 years, we've hauled that grain off the farm and haven't even thought about that. We're coming back to that model where that farm, we're going to walk grain off the farm because it's cheaper to feed it, and then walk it off in value-added product, as in livestock. Your best market may not be that terminal elevator or that railhead or that port on the river or the Gulf of Mexico. It may be that livestock producer that is a county or 2 counties over. So I again want you to think about that and what is that local market, and think beyond maybe what you thought about before. The corn balance sheet, we've talked about that, but I talked a little bit about, here's some of the highlights of our baseline. I talked about the feed side. Exports fairly stagnant. We continue to see pretty high prices, and the challenge was going to be the profit. How do we make money producing corn? The good news about corn, yields continue to go up, surprisingly under maybe rather adverse weather conditions since the drought of 12, we continue to produce a crop going forward. And that's one thing the market's reflecting. It's going, well, they told me it was wet and it won't be a crop, and they told me that last year and we still produced a crop, and now we did see a change this year, but the fact that we still produced a crop that maybe a lot of us thought we wouldn't, and that's remarkable to me. But there's the planted acres. We do see probably 75% probability they're going to stay under 91 million acres going forward. But think about, and again, like with wheat, corn's really the king of this. As yield goes up, we don't need as many acres, and we don't need as many acres in the United States to supply the demand we have right now. If we look at corn, that's the biggest challenge in the corn market. What is that new demand that we haven't tapped yet? Is it E15? Is it a feed? Is it some other technology that comes out of corn milling that we don't know about today? Maybe it's biodegradable plastics. That's the big challenge for the corn market. And that's very well reflected in prices. Looking forward, 75% probably they're going to be under $4 as we get past this year going forward. So that's sort of the challenging part on corn. I'm going to go forward real quick and just talk about beans real quickly. For those of you to buy beans, obviously the trade war is the big issue. But as we've said, we've ceded a lot of ground to Brazil in this issue over the trade war. And so beans are going to be very, very, of all the crops I've talked about, they're going to be the most challenging going forward to look for opportunities there. It will be in the rotation like wheat. It'll be, and for some of you, it'll also be corn will be a rotation from potato perspective. But we see a lot of challenges with beans going forward. Yes, ending stocks have been cut almost in half this year, which is remarkable. But the fact is that demand side really hasn't grown much at all. It's grown very, very small. And I think, the Chinese are going to be price buyers. They felt slighted. So why would they come back to someone that they've in their mind has treated them very badly? So when we look at, when we look at our price curve and we look at the ending stocks for 2021, when we look at the fourth quarter, beans right now are trading about a 40-50% premiums where they should trade based on the fundamentals we know today. So bean sales now probably are where the opportunity is. I will also tell you on corn, we're probably trading about a 20 to 30 cent premium as well. Again, think about that as you go forward and think about the marketing window we're in, because we get planting perspectives March 31, then that window shuts because the market then says, oh, we have, potential is we have a lot of acres that didn't get planted last year. There's some highlights from the bean. Beans have a lot of things. The trade issue obviously is an issue. Will the Chinese come back? African swine fever has certainly cut the demand, but that demand's being picked up in other parts of the world, the U.S. being a big one. We're seeing more chickens and more pigs being fed that will eventually go to China or go into Southeast Asia and find their way into the Chinese market, because pork is very, very expensive now and they need the meat. But if we looked at planted acres, we do see them going back up 75% probably. They're going to stay around that 85 to 86 million acre area as we go forward. It's going to be a slow climb because the profitability on beans is very challenged right now. National average price on soybeans is going to be kind of $9.60 or below. It's going to be tough to get them above $10 unless we can see exports go up. We have seen Chinese exports go up this year, but we have not, but they're certainly not to the level they were back in 17. They are above a year ago, but a year ago was very, very low, and I will show you that in a minute. But I do want to show one thing about the model, what this has cost you as far as from a price. In the model, we assumed that ASF would continue over the 10-year baseline and the trade war would continue. So, and we do think the trade war, this is a long-term thing. The trade war alone shaved $1 to $1.50 a bushel off the national average soybean price. ASF was worth shaved about 50 cents to $1 off prices. So we've seen prices for soybeans discounted or depressed by $2 to $2.50 a bushel because of what's happened with ASF and the trade war. And that was kind of an eye-opener for us to look at and go, wow, it really did have I mean, we knew the impact was there, but to quantify it and really think about what that number is and start to multiply that out is pretty staggering. There you see soybean exports is the red bar this year. It is above last year, and the blue bar is last year, but you can see we're in that time period where exports are going down. And so to think about the Chinese wanting, they may want to, or the U.S. may want them to, but to think about that they're going to go counter-seasonal where they have been with the Brazilian crop coming in is probably going to be, is a little bit, I think, a little bit of a wish at this point. So I'm going to finish there. My time's up. I will just make one shameless commercial. Go to your favorite your favorite podcast. We do a North American grains and oilseeds podcast once a month, and we talk a lot about a lot of different things. And we do try to bring in some of our global analysts to talk as well. And this past month we had our analyst from Brazil with us, and so we had a chance to talk to him. Had a great conversation. So, with that, I will finish, and I will turn it back to Dale, I think. Thank you very much.